Hey everyone, thanks for joining me today. In this video, we're going to take a look at the last week in the market, go over some key earnings reports, how these companies performed, how their stocks moved as a result, and I'll give some of my thoughts on these companies moving forward. If you like this type of content, please subscribe to the channel in the bottom corner, hit the like button. Also, would love to hear from you guys in the comments if you have any thoughts on any of these companies or other companies that are about to report earnings. So let's just get right into it. On Monday, a couple key earnings reports, FuboTV, Zoom. I also was really interested to hear from Berkshire, but I'll do a separate video just on that. So jumping into Monday, FuboTV had a rough week. They lost about 50 cents a share just in the fourth quarter, which is, if you start thinking about it, crazy that they're pretty much losing over a quarter of the value of the company on a cash basis just in 3 months of operations. There's obviously lots of ebbs and flows in terms of quarter to quarter, but even when I look over the last 4 quarters, net income minus 140, minus 120, minus 150, now minus 150 again. So just in the last 2 quarters alone, minus 300 million in net income for a business that's currently worth 360 million. So this is a really risky stock, really risky gamble. It is a relatively small market cap for the market they're trying to serve and play in here, but they really need to achieve scale and achieve it fast. While they have revenue going up 200 to 300 in over the last few quarters, they really need exponential growth to fix the economics of this business, or they're just going to have to keep taking on more debt or releasing more shares and diluting shareholders further to make this company successful. And I'm just not sure that equation nets out to something that's positive to shareholders at this point. So this is super speculative, more of a gamble, not one that I'm interested in, but was just shocking to see how big the losses still are at this company, even a couple years into the journey now. Zoom, this was a stock that I was just interested to see how the market would react to. It's a company that had very low expectations, and they actually beat their revenue estimates. But I think throughout the week, while the stock did pop, I think 5% after hours, that never materialized during the trading day. While the stock did pop after hours by 5 or 6%, when you take a step back, if you look at all the cash they produced in the quarter, it was more than offset by the outstanding shares that they released and share-based compensation. So net, when you factor that in, this company's like not even making money. It's on a downward spiral since it's never going to get better than it was in COVID. Lots of competition, over a $20 billion valuation, not one that I'm overly interested in as well, and was just interested to see the shift in the stock from being up 7% after hours ultimately was down 5% on the week. Norwegian Cruise Line. So Norwegian had an interesting week. You can see they dropped 12% on earnings. They kind of came back later in the week as the broader market, you can see at the top, today's kind of rallying a bit. But overall, I'd say I was not impressed with their earnings either. They had really soft outlook. They missed their earnings for the fourth quarter. I think just putting the past behind us and looking forward, couple things. They still have $13.6 billion in debt at the end of the year. And then are things getting better for them? Sure. But even in Q1, they're expecting to lose 45 cents a share. So this company's still losing money, even though demands come back. And when we look at the full year, I believe their estimate, having trouble finding it, here it is. Their estimate is projected to be 70 cents of EPS. So these companies used to trade at like 10, 11 times earnings pre-COVID. Now, this year, they're trading at like 23, 24 times future earnings with a terrible balance sheet. So I don't see how this is a great investment at this point, at this valuation. That's crazy to be a $7 billion market cap company with $13 billion in debt and making 70 cents a share, hopefully relying on the back half of the year to deliver that, since currently they're still losing money quarter to quarter. I'm just staying away from this space for now. Hopefully one day they regain like unit economics and margins per passenger and stuff. But I just don't really understand how this has been such an issue to get back to profitability unless it's really just paying down or paying the interest on the debt, because that's the only thing that's really changed other than just general costs going up between now and 2019. So disappointing to see that. Hope they turn it around. One last comment on the cruise industry here is they do call out that Royal Caribbean actually outperformed Norwegian. So this may just be some like bad execution, company specific stuff. And lots of analysts are actually upgrading Royal Caribbean as being kind of the best in class cruise operator that you should be investing in their opinion. So if you're interested in the space, make sure to maybe look around. I would personally be looking at the balance sheets and take the one potentially with the least debt to earnings ratio, just to make sure they can pay that off as they kind of transition into this new period for the industry. We have a lot of retail earnings from this week, and going into back to our chart here. Target was the other one on Tuesday. I wanted to talk through. So Target, just on their stock for the week, essentially flat, trading at about $165, which is $76 billion valuation. As we look at their report here, we saw them have very slight growth, I think 1% on the quarter, but they continued to warn about consumer slowdown in discretionary categories and stuff like that. So this is a stock that I believe is forecasting 775 to 875 in EPS for next year, about 5 to 10% below what analyst expectations were. Closer to $9 to $10 is where people were hoping. So I'm actually surprised the stock did not go down more. At $8, it's trading at about 21 times for a company with broader exposure to discretionary purchases and stuff like that. So this is a stock that personally not interested in at these valuations. Think it should probably be closer to a 17x, so something closer to $130 stock would be more fair value. So not one that I'm interested in or enticed in jumping in any way whatsoever. The next stock, as we move on to Wednesday, is Wendys and Lowe's are two names that I was really interested in. Wendys, just because I own other restaurant businesses and stocks, and Lowe's, I just find this space to be an interesting niche of retail that's very defensive against e-commerce, can really boom in a strong economic environment. And those were two that I definitely wanted to take a peek at this week. Starting with Wendys. So if I go to the 5-day on Wendys, slightly down. What's really interesting about Wendys when we look at their numbers, so this company made about 86 cents in EPS on the year. So trading not at an overly cheap valuation. That's about a 24-25x, which I would say is average for a high caliber franchising company. You can kind of see like quick service restaurants or Restaurant Brand International trading at that 22-23x. McDonald's trading 27-28x. So they kind of fit right in there. I think it's probably fairly valued for what it is. What's really interesting, and I'm interested to look into it more, is they're paying a 4.5% dividend, which I believe is more than they even brought in both free cash flow and EPS. So that's really interesting to understand how their dividend got that juiced, and is it sustainable? Is it holding back the company? That's something that I definitely want to look into before potentially investing in a company like that. So just a call out there, but overall seems like they slightly underperformed, stock down a bit, but still a solid business at the right valuation. And then going into Lowe's. So Lowe's also down a couple percent on the week, pretty stable across these retail names. So I'll just fly through it. But ultimately, very similar dynamic. Offers a soft sales outlook for the quarter. Talked about being a bit more cautious about the consumer. As we look at their outlook for the year, they're thinking about $13 to $14 in EPS, right in line with analyst estimates. At $200 a share, we're talking about 15, 16 times earnings, which I think is directionally fair. Home Depot, I think, is trading 17, 18 times, and they usually trade at a higher multiple. So I think it makes sense if you're bullish on housing long term, renovations long term. Probably not a bad time to jump into these companies, but one that I currently have no exposure to myself. Costco, one of the best retail companies in the world, and they are priced like it too. So currently trading 35, 36 times earnings, I believe. If we just take a look at what happened this week, down 4%. So similar to the rest of retail, they called out a bit of a weakening in the discretionary uh, portions of the business. So high cost of food was a big revenue driver. Not high margin space at all, and not good for the consumer to have to be spending more on food, especially when it may have directly fed inflation and other pressures on the consumer that caused a slowing of big ticket items where they probably make a lot more money. Think like TVs, stuff like that. So, really interesting shift in spend, and to see that Costco is still able to perform relatively well in this environment. They just weren't able to blow it out of the water. And unfortunately, when you're a retail bricks and mortar company that's trading close to 40 times earnings, you really got to drive top line, bottom line in a really big way to justify a valuation like that. I'm surprised this company's not down more, but lots of people love Costco for the long haul. So to each their own. In terms of one thing that's important in their release here, I'm just trying to find it, but revenues from membership fees. So this is ultimately what goes to Costco's bottom line. They tend to use their gross margin from the store to kind of cover costs and stuff. But the quarterly revenues were $1 billion, or they just crossed the $1 billion mark. So that's great to see that their member base is growing, and they continue to drive more revenue and super high margin profit from that segment of their business. Okay, going into the last segment of retail. Once again, similar story. Best Buy down $1.50. This one trades at the cheapest valuation of them all at about a 12 to 13 PE, given just almost complete exposure to high ticket items, and especially what you saw Costco say. That's a bit concerning in terms of how strong the demand may or may not be in those segments. Um, Ultimately, yeah, Best Buy is probably not best positioned out of all the retailers, but they do have a big buyback program going on right now. They do pay a juicy dividend. They are trading at 12 times. So if you think an economic boom's on the way, this isn't a terrible stock to consider nibbling on or adding, in my opinion. Personally, don't own it. But out of lots of these retail ones, just based off valuation and the dividend, might be one I'd consider myself, assuming I don't think, a big economic collapse is on the cusp. AB InBev, so this company owns beer, like biggest beer company in the world. They had an okay week. I was actually surprised. They lost revenue for or volume rather for the first time in a very long time. So they had a reduction in unit sales, but they made up for it in pricing and moving people up into more premium beers they own, like Corona, Stella Artois, etc. So I just think the beer category itself, which is where they primarily play, is clearly in some level of secular decline. More people moving into other spirits, other kinds of drinks, mixing with harder liquor, whatever it may be. And they're really not positioned tremendously for that shift to prosper. It's going to hurt them a lot more than it's going to help them. And we're seeing that flow through. They're trying to not cover it up, but they're trying to mitigate it by pricing, by trying to trade beer consumers up into premium beers. But you can only really do so much of that stuff if you're losing customers and users over time. So a bit concerned on this one. Will not be a buyer at these valuations. TD, which is the only stock that I actually own out of these names, down 2% on the week. Couple of comments on TD. One thing that dropped the stock a bit, um, keep in mind this is about a $150 billion company, but they settled a Ponzi scheme lawsuit just around one of their clients that was running a Ponzi scheme, and there were some flags or things that the person who filed this think that TD should have been able to pick up on or figured out they were doing a Ponzi scheme. So it's not like TD was doing a Ponzi scheme. They just were sued for providing financial services to a company that did and maybe not seeing red flags in front of them. Anyway, I kind of got a bit of a chuckle behind this just because it's saying here how it was three big banks involved that they were suing. TD and HSBC, $10 billion each, another bank for $6.5 billion. Overall, they've recouped $1.6 billion from financial institutions. And we see some banks paid $150 million, another bank paid $100 million. No one admitted to wrongdoing. Somehow TD ended up paying $1.2 billion. So not sure why TD had to pay 10 times as much. Maybe they have a bad negotiator. Maybe there was more damning evidence in terms of red flags with TD. But that was kind of a bit of a slap in the face, and the stock did go down on that a bit. Probably a bigger hurt, both financially and reputationally, than people were anticipating with that lawsuit. Other than that, on their quarterly earnings, I actually thought their numbers were pretty decent. Some other things that are going on with the company, they're currently been trying to close on 2 acquisitions. The smaller one is Cowen, which is kind of like an investment bank. They do lots of analysis. I hear them on earnings call all the time, asking questions to different types of companies. And they finally closed on that deal that they announced last summer, I believe, for $1.3 billion. That'll really beef up their TD Securities business in the US and their investment division. But the bigger company they're trying to acquire, First Horizon, continues to get delayed. US regulatory and regulators want to keep putting up obstacles and roadblocks to M&A in the financial space in the U.S. Elizabeth Warren's called out TD for not being a good actor in banking, which is ridiculous. But things like, the Ponzi scheme affiliation, just whether justified or not, fuels the fire for politicians who don't really understand the scope, and it's just like the headline news and politics and stuff like that. So hopefully this deal does end up getting put through. But if it doesn't, I imagine TD Bank will start buying back a lot more shares, making a lot different types of investments to organically build their US business. But this would definitely be a big jump in the US if they're able to pull it off, and very accretive on earnings per share. So as an investor, really hoping that this deal does go through. Generally, I don't think investors care that much about it, because I don't think that was a big part of their drop this week. If so, it was like 1%. So overall, I don't think there's risk to the stock necessarily in the short term if the First Horizon deal doesn't close. But just personally, I think it would be a good way, given how much cash they have on hand, to accelerate their revenue and EPS. So tried to go through that as quickly as possible, given how many companies were reporting. But that's kind of a summary of the stocks I was looking at this week, how they perform, my thoughts on them. You'll notice that lots of these companies I'm not actually buying. And the great thing about the stock market is you do not have to invest in anything. There's thousands of companies out there, and in a portfolio of 10, 20, 30 stocks, vast majority of the opportunities that come your way are going to be a no, and that's completely okay. So some of these stocks that I like, or businesses that I like, I'm waiting for them to get to valuations that I find attractive enough and enough upside, limited downside to add to the portfolio. If not, I'll just continue watching them. And that's just kind of how I do it. So if you like this video, if you like this type of content, please hit the like button, subscribe to the channel. Would love to have you for future videos. If you own any of these stocks or have anything to add, would love to hear from you in the comments. And I'll see you guys in the next one.